Welcome to another weekly market insight where we sift through the noise to give you actionable advice so you can make informed decisions. Joining me today is Chris. We haven't been here in a while, right?
Yeah.
It was a little bit of, it wasn't natural talking about the intro because it's been a couple of weeks. It was warm when we left, and now it's cold here in St. Louis. How was your break?
Everything was great.
Yeah? Did you pay attention to the market?
A little bit. Yeah.
Did you see that we had a Santa Claus rally?
Yeah, good call.
Good call.
Good call by you.
It's not hard. It's like an 89% probability of it being likely, right? So let's review our 2021, speaking of calls.
Yeah.
I think we got a lot more right than what we got wrong. And then there was a couple of things that you can go either way and you can make an argument, or it really was just indeterminate. You can't really decide. But COVID-19. I think we said that basically there would be a wave in early spring, but for the most part, the market was going to begin to ignore it. And I think that call was spot on. We'll get into 2022. Hopefully we won't have this slide there, or that box there in 2023.
That behind us.
And then we can get into monetary policy.
Right. We said that central banks would be accommodative and might be the only game in town.
Might be the only game. So I don't know if that's indeterminate or not because we put a might or a maybe in there. I think we were kind of already hedging our bet there.
Certainly they were accommodative.
They were accommodative. Was it the only game in town? I think you can make arguments that there's a lot of things, innovation and different ways of thinking, different approaches, a lot of infrastructure to build that out that are actually taking place that would probably be there. We did the Georgia runoff at the beginning because at the beginning of the year we still didn't know who was going to control the Senate, so we threw two out there, and we said if the Democrats controlled, we'd have an infrastructure bill. Well, we had a lot of talk about an infrastructure bill.
Seems like every week.
And it went all the way up to the end of the year, but that did not go through. I don't think it's going to go through this year. So that one is...
Do you think they're going to try to scale it down?
Politicians love spending. Of course, they're going to try to scale it down. I think the focus is going to be elsewhere, though, as we're coming in, because of the next point, which is populism would continue to grow. And it really was below the water level. You couldn't see it unless you were looking for it. But if we looked at the special elections, we had the New Jersey election, which I think is just characteristic of this. This movement is still out there and continuing to grow, where you had a candidate who spent, what was it, $500 on a race and beat an incumbent, entrenched, very high up state senator off of $500 and basically just putting an R at the end of his name in a very blue area of the country. So I think the Democrats are really concerned about what the election is going to look like, and they're going to be trying to think, how can I prevent a red wave, or at least the red wave taking me out? So I think that's where the focus is going to be going in to the year.
Getting into domestic economy, about 4.5% growth, expansive economy.
Expansive economy, probably not a hard call considering the amount of money that was poured into the economy. So we knew that the GDP would come up because it's government spending. If we look at the calculation, C plus I plus G equals GDP, and G is going to go through the roof, well, GDP is going to move up as well.
And inflation was not a surprise to us.
It wasn't a surprise to us, but it was a surprise to the market. They did not expect, they thought everyone was going with transitory, thinking the Fed had it right, for good reason. 2008, we did a lot of money printing, and really inflation hasn't been here for decades. But some of those forces have kind of gone out, especially the labor market, something that we'll talk about throughout this year.
Something we got wrong.
Yeah.
Currency.
Well, man, that one was a miss. I can't get that in a darker shade of red on that. That the dollar would reduce imports and increase exports. Dollar strengthened, and the amount of money that was created by the federal government to deal with it while everyone was basically sitting at home increased the demand for imports beyond anything that the system could actually digest. There's an enormous amount of congestion in the supply chains. We've talked about that throughout the year. That one was the wrong call. We did not see that one coming. But inflation returning to the broad indexes, we had that. That kind of goes back with some of the other things that we had said. Technology improvements kind of dampen inflation. You can argue that, but you can't prove either way, right? Another one, emphasis on automation. We definitely see the beginnings of automation. I actually saw that there was a semi-truck that drove from Phoenix to Tucson, or maybe it was the other way, completely autonomous. There was not a single driver in the vehicle while it made this trip. So part of that labor issue, we are starting to see automation, but not as quick as I would have guessed at the beginning of the previous year. Then
Moving internationally,
Yeah.
global GDP about 5%, a little light on that, it was a little higher, but we're wrong in emerging markets.
Yes, mostly emerging markets. We thought the yuan would appreciate and do well, but China really was struggling as an economy. We have Europe and Japan to continue to struggle with demographics. When we get into the 2022 box, we actually add China there. So we think the emerging markets probably is going to do well going forward, and did okay, but when you take China out, and we think that's going to be a repeat this year. Stock valuations, we're going to talk about, and you're specifically going to talk about valuations. Where are we on market valuations? We're actually going to give a market call with all kinds of disclaimers on there. But technology continues to lead after a value rotation. If you look at the broad index, that certainly was the case.
Large cap technology did well.
It did do well, but it did have a bumpy ride at the beginning. Basic materials, we thought they would benefit from infrastructure spending. Go back to the policy, and we didn't get the infrastructure spending, so not too much of a surprise there. Commodities did okay at the beginning of the year, kind of have dropped off, but basic materials were below the average index, so definitely was not a great call on that. Healthcare recovered if it was a divided government, and you got to argue what is a divided government. If you look at just D's versus R's, the Democrats hold both the Senate and the House, and they obviously hold the presidency. But it acted more like a divided government, especially towards the end, because of Senator Manchin really pushing back, and we ended up having a divided government. Healthcare didn't do poorly, but it did not outperform the market. And then I think this one's an easy call whenever you have all the tax fears at the beginning of the year with the increases. This is not on there, but one of the things that I said is probably wouldn't see a big change in tax code. If anything, SALT would come back, the ability to deduct a lot of your state and local taxes. So I'll claim a dark yellow or a light green on that the tax policy didn't materially change, but we did definitely see munis perform well with the fear of that. And yields are certainly below inflation, by quite a lot last year.
We didn't put a duration number on there, but we did say we wanted to stay short duration, short on the yield curve, and that was the right play for the year.
Absolutely. And then we mentioned that yes, there is a debt bubble. The debt bubble got much bigger over the year, but we still don't think it's ready to pop just yet. So then let's get into what do we think is going to happen in 2022. Dusted off the crystal ball, trying to figure out what that is. I would say that COVID is probably not going to be on the slide in 2023. Omicron as a strain, it is certainly transmitting quickly, but the symptoms are much more mild. It's actually causing kind of a natural immunity vaccination for populations. And then if we get into that political component, probably hurts the Democrats if we have the election today. Who knows what happens going forward? There's still a long time before November election. So I would expect the Democrats are going to try to distance themselves from COVID, so we're going to hear less about that. Monetary policy, we're going to spend a lot of time on this part in one of these calls, because I think this is going to be a big story for 2022. The Fed is saying they're going to taper, and they're going to try, we had said that they're behind the curve when it came to inflation. They're going to try to get caught up. That definitely can cause some disruptions in the market, and we want to get into that.
Did you catch their inflation expectation for 2022?
What was it, 2.4?
2.7.
2.7. It's, yeah. If you look at headlines and you just go back, I think we talked about this on our last call, and just the numbers, you're going to have negative numbers on some of those months to get anywhere close to that. It's already baked in the cake for.
We're expecting to remain in the 6 to 8 for a few months, and then slowly come back.
Probably come around to 3 to 4 as for the end of the year. Domestic economy, we want to go into this because this one's kind of confusing. It's going to take a call, but talk about how the labor force is going to impact profit margins in stocks, and kind of look through this in great detail. We got a great talk that's lined up for that. International economy, we kind of covered this in on the previous slide. Not much has changed. We think emerging markets will do good except China, and we think that domestic economy in China will do poorly, and a lot of it has to go back to the demographics. They're in there with Europe and Japan on poor demographics. We're going to talk about stocks and the valuations and what we see going forward, and kind of give a projection of what we think will happen, or at least what our baseline number is for 2022. And then fixed income, kind of with monetary policy, unfortunately they're very linked at this point in time. With what the Fed does really controls the fixed income world. We're going to spend some time on that in another call as well. So why don't we jump into
start with price to earnings?
Yes.
And we talk about it a lot, and the question we always ask is, do they matter? You know, some analysts say they do. You talk to JP Morgan, they have 15 slides on it. You talk to some other analysts that say it doesn't really matter. They tend to go higher over the years as the money supply tends to go up.
Right.
And we usually tend to be somewhere in between.
Right.
They matter a little bit, and trying to predict where they're going to be is a difficult task. So we figured we could start with a slide from Professor Siegel, who says they do matter, and because if you look back historically, they show lower PEs have returned much higher than higher PE stocks.
And Professor Siegel, we've had him on the call. We need to have him on the call because he is very well respected. He knows what he's doing.
We podcast with him middle or early last year.
Yeah, so it's our highest view. So if you just search for highest view on this channel, you would see his talk. You certainly have to listen to Professor Siegel. And when we look at his research, he's got the lowest PE all the way up to the highest PE. And it definitely bears out that narrative. But then there's a lot of things where you're backfitting and other things that come into play. One thing that I found interesting is his lowest PE, 12.43, is below the low, which is confusing, at 12.57, meaning that's not just a linear graph.
Right.
If it was just linear, you would say, okay, well, low PEs often do give a sign of trouble, right? Whatever the price is, there's a compelling bear case and there's a compelling bull case at that moment that are equal. Otherwise, if one side is going to win, that price is either going to move up or move down based on which one has a more compelling argument.
PEs are oversimplification.
Very much so.
They can't be used as single variable.
Right, and well, there's multiple factors that are going to be at play, right? Let's...
Yeah, we talk about interest rate risk in equities, but I don't think we've ever shown a graph or done an example. This is just, we did an oversimplification of a stable company and a really high growth company.
Now, can you give us a definition of what you mean by a stable company?
Yeah, so for this, I used numbers from a grocery store.
Okay.
Something that's growing modestly, 1-2%.
High competition, so not big profit margins,
Right.
not a lot of money to do innovation and research, right?
And then I used the highest growth stock that we follow as a software company.
And we're not going to say which one
No,
because then they'll have
we
to
might
cut
get taken
out,
down,
right? Yeah. But it's out there and you would know it.
And we do talk about price to earnings, and when you use a P and an E, you're only looking at 1 year. Well, we know that stocks are worth discounted cash flows of many years. And when we look at the stable company, we can see, sorry, I didn't explain what the graph is showing.
Okay.
It's a percentage of total value derived from the cash flow in that year.
Right.
So 6% roughly of the grocery store is derived from next year's cash flow.
So if it's a $100 stock, $6 of that $100 price is just what the value of next year's earnings are going to be.
And if we look at a growth stock, well, they don't have earnings for 5 years.
Yeah, so you had to go out 12 years just to show this because there isn't any earnings. So if we were to do it the same scale and we look at the percentage, and I'm stealing your thunder here, sorry, 99% of the value of the growth company is somewhere out way in the future. It's not realized. Well, what does that do if interest rates move up?
Interest rates move up, it's going to get hit a lot harder.
Right.
So just a simple example, interest rates increasing by 1.5%, both values are going to decline, but the much aggressive growth stock is going to decline by 10 percentage points more.
Now, does this mean growth stocks are bad?
No. But this is just starting to kind of get our ideas of, well, we're not saying to sell our software companies and buy grocery stores, but reducing our PE ratios slightly makes sense to us.
It does, because we do see that. But if we were to just try to be defensive by buying what looks like stable companies, which tends to be utility companies, grocery stores, Procter & Gamble, like where they're creating consumer staples, there's not a lot of innovation, there's not a lot of future growth. Procter & Gamble isn't going to have the earnings growth that, let's say, in Amazon 10 years ago. So you can't just say, get rid of growth, we want to be low PE. We want to be a value trader because that always wins out. And I think Professor Siegel would be an advocate of that approach. It certainly hasn't worked over the last 10 years. So don't abandon the growth companies because that is the growth story that's out there. Just be mindful of how the interest rates can affect the valuation of your portfolio. Speaking of valuations, why don't we take a stab at what everyone does?
Yeah, I think everyone does it and they're kind of uncomfortable doing it, but they still give a price prediction for the S&P 500.
Now, the odd thing about the prediction is you're saying, okay, if we assume a bull case scenario A, and then we assume scenario B, and then we assume a bear case scenario C and D, and then we just average that up, we come with a number that was in none of those scenarios. So there's a scenario X, Y, Z that no one has ever predicted, but that's your price target.
Yeah. Yeah, we weighted it with some weighting. We're not going to tell you how, but we weighted it.
Yeah, proprietary.
Proprietary, yeah.
So what do we have for evaluation?
Well, we kept it pretty simple, and we said, well, let's look at kind of the base case from what analysts are expecting, somewhere around an 8% growth rate in corporate earnings. And we applied current market PE ratio, which is slightly higher than 21, but say it comes down a little bit to 21. You're going to get an ending value of a little over 5,000, between 5,000 and 5,100, which is, I think, what we said on the first slide, 6% upside in the market.
So not a big market rally here. That is what we're assuming for our kind of our base case or the average case out there, but it's still a positive number. And then look at that bear case.
So the bear case is derived from saying, well, we're still growing, corporate earnings growing at about 4%, so that is a significant pullback. And well, what PE ratio would you use for that? Maybe a historical one over the last 20 years, which is 17.
Now, one of the things about using a historical one is you would have to go back and say, well, a function of that PE is the interest rate. So then that means you would assume interest rates move up to its historical average before you could ever justify a 17 PE. Probably not going to be the case. But I would say that if we did it, that's a market to buy. And one of the things that I would say, so we have our price target of, is it 5,061? That's our price target for the end of the year. I wanted to say 5,500, but I knew that was not right. Is kind of just went off, is that, that we're likely to see a market correction in 2022. The Fed is beginning to taper. Which is reducing its bond purchases, and that's going to likely be done here in the next couple months. Which will cause interest rates to move up, kind of moving towards maybe that 21, 20, 18, possibly 17 if interest rates were much higher. I don't think we'll get there. So you could have that technical correction. A technical correction is 10% off of the high. And if they were to mess it up significantly, I would say bear market is not out of the realm of possibility. So we could be down to 37.91 off of that. But here's the thing: is we don't know what the high is going to be. As we're moving into an economy and the Fed is beginning to taper, a lot of people interpret that, probably rightly, that the economy is strong, that it's growing, that it's moving. So there are going to be people that are buying through this. It also takes time for the Fed to slow down its purchases before it actually starts to affect the broader market, specifically price values in the market. So let's say we're down 10%, but we had a rally the first couple of months of 12%. Well, if you were to get out just because you say, hey, the correction's likely, you missed out on 2%, even though you were correct. And in addition, a lot of that volatility is going to be caused by the Fed tightening, and they can just as quickly loosen. So if we do have a correction or even a bear market, we think it's going to be one and done and over pretty quickly. So we would see that as a buying opportunity. Now, we would not try to time it. What we'll try to do is dial back some of the risks. So if we were to have all-time highs in our portfolios, we'd see that as an opportunity to raise cash, especially for cash reserves and cash targets that we encourage clients to have, and put some of that money off to the side. And if we did have a correction, maybe even put some of that back in or just spend it down, knowing that we got a high in the market.
So I think you said it pretty quickly. I think you said the Fed messed this up a little bit. Did you mean maybe they act pretty quickly when they say, we know they watch the market, but maybe they say inflation, they admit inflation got away from us a little bit, and they do say a 50 basis point raise instead of what everyone's expecting, which is 3 to 4 25 basis point increases across the year.
Yes, I would not like to use the term hawkish against the Fed, but they are definitely behind the curve and they know it. So they're going to try to get ahead of inflation because they don't want a psychological change in people's minds. So it's much easier to kill inflation off quickly before it becomes the norm in our minds, and then have that deflationary pressure, and then basically allow rates to go back up and correct that quickly. So I think they're more likely to be aggressive than they are lenient, just because of where inflation is at the moment. And I think that does increase the chance of a sharp correction, but one that's caused by monetary policy, so it's just as easy to unwind that monetary policy, since that's the actual cause. I make that a little bit more clear?
I think so, yeah.
So expect volatility. Know that we're going to be continuing to watch it, especially that money supply as we're tapering. It is growing strong as we go into the year, so we want to stay invested. We certainly are looking at changes in the portfolio now that we're at the beginning of a year, especially in the taxable accounts where we can reset that tax gain. No change in our theme. We still think inflation risk is high, though not as high as it was last year. Continue to favor equities over fixed income. Fixed income is losing relative to inflation. Even if inflation is at 4%, you're not getting anywhere near that on your bonds. We continue to favor the U.S. domestic market. Favor technology sector, but with the rising rates, we're trying to manage that. That's still the growth story long term, but we do have this effect on PE ratios that we were talking about.
By favor equity over fixed income, are you saying, accounts have a little bit of drift from equity appreciation that didn't happen in fixed income? Mm-hmm. You like continuing to maintain that drift within rates that we've talked about.
I think the role of a bond now is only just to reduce some volatility in the portfolio. They're not keeping up with inflation. You're just not getting compensated. I like to call them return-free risk because you are taking some risk. And I think if we look, and we will here in a minute, we'll look at what the return is on that conservative risk-free bond, which I think is going to continue to repeat itself going forward. Bearish on international and China. We took real estate off of here. We were bearish on real estate, neutral in our portfolios, most of them, but real estate was one of the best performing asset classes through the year. So that one would be a red also if we had that at the beginning of the page. So markets near all-time highs if we're looking at the S&P 500, not a diversified account. Any other thing that we want to cover for this call?
No.
All right, well, we appreciate you tuning in, and if you have not subscribed yet, please click that button down below and subscribe. If you think that there's anybody that would benefit from listening to this, click that arrow, share it over, and send it over. And if you haven't done so already, please hit that like button, and we appreciate you doing that, and we look forward to having a conversation with you next week.